Okay, good morning, everyone, and welcome to the first of our Coffee Microcaps morning meetings for results season. It's going to be a busy couple of weeks here, Coffee Microcaps. We've got a few of these events coming up in the next couple of weeks, so I'm delighted to kick off with this morning's one. I've got a couple of intro slides I'm going to run through, and then we'll get straight into it with our presenters for this morning. For anybody who doesn't know me, I'm Mark Tobin. I'm the founder of Coffee Microcaps. And for all our regular attendees, welcome back. And for anybody who's new to us here, you're very welcome. I do just want to give a mention to RAS Research as a Service, who are our sponsor here for all our online events at Coffee Microcaps. If you are looking for some institutional grade research on some small and microcap companies listed on the ASX, please do check out their website. They've got a good number on there, and it's all free. Compliance and disclaimer slide, and welcome to any of our friends from ASIC who are joining us this morning. For anybody who is joining us for the first time, companies we tend to have on here are capped under 300 million, our definition of microcap, generally in revenue, heading towards cash flow break even, or indeed, like our this morning's presenter, already profitable. We tend not to have companies from the resources and biotech sectors, what I like to call industrial microcaps. Structured this morning's webinar, we're going to have one company presenting with us this morning. We'll break it down roughly into a 30-minute session with 20 minutes of a preso and 10 minutes for Q&A. If you do have any questions for our presenters, please type it in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions. And please note the webinar is being recorded and it will go on the Coffee Microcaps YouTube channel on Monday. You can follow us pretty much on all the socials, Twitter, YouTube, as I say, for this recording. And indeed, we've got over 200 company presentations on the channel now, and all the upcoming ones will also be on the YouTube channel. So if you can't make some of the other sessions, please feel free to check them out on YouTube afterwards. And I do write a newsletter which goes out on Substack every month, which you can subscribe to as well. I'm delighted to welcome back John Lorente, CEO of Big River Industries, and joining John is another John O'Connor, the CFO of Big River as well. So without further ado, I'm going to hand over to John Lorente, I think is going to kick us off. So John, if you want to start sharing your presentation, I'll let you know when it's up. Yep, I can see the cover slide now, John. You can take it away when you're ready.
Great. Thank you, Mark, and welcome all. Thanks for taking the interest in Big River. As Mark said, my name is John Lorente, and John O'Connor is our CFO. Today we'll just go through the announcement from yesterday, and then also give some background to the business and a bit about our strategy. So if we go on to slide 2, and I'll make this one work. Okay, so I won't read through this whole slide, but just maybe some main points, just a bit about the history of Big River. So Big River's been around for a bit over 100 years. Proud family business out of Grafton, New South Wales. It was sold to Anacocha Capital back in 2016 and then floated on the ASX in 2017. And we've had some substantial growth since then. 10 odd sites back when it was floated, now 26 sites. Onto slide number 3 there. So business overview. Some of you would have seen this slide before. One of our key strengths for Big River is the geographical segment and supply chain diversity. And you can see there on the left-hand side. So 64% of our revenue comes from local source suppliers, and that's increased over the last 12 months as we consolidate purchasing across a group of local partners to get some of those cost benefits. The revenue by construction market, obviously we've seen that residential market come off, which you've all would have heard in the media. And that's come off from peaks of 44% of our revenue to 39%, and largely driven by frame and truss. But pleasingly, we're now starting to see growth in the commercial volumes as strong project pipelines are delivered. And then the revenue by region there on the left-hand side. Queensland, well, the three big states obviously is where the majority of our business is. But Queensland is our largest footprint, which bodes well for the future, with Queensland forecast to be the largest growth region in Australia in the coming years. And then onto our asset mix there on the right-hand side. The acquisition of SLQ back in on the 1st of May takes us to 26 sites, including 8 manufacturing sites. And one of the key things we've been working on this year, and John can talk about it shortly, is we have amalgamated a few sites to get cost benefits, particularly as commercial rents increase. We'll go on to slide 4 here, and a bit of background on the divisions. I won't go through lots of detail, but just for those of you who don't know the business well, we run 2 core businesses: panels and construction. The panels business is an industry leader in decorative and engineered panels, dealing predominantly with cabinet makers, fit-out trades, and OEMs. We've expanded this business substantially over the last few years, both organically and by acquisition, delivering differentiated high-value offering to the market. We now have 9 sites, including 4 manufacturing sites across the east coast of Australia and New Zealand. The construction division is a leading diversified formwork and building products manufacturing and distribution business focused on trade customers. The majority of our customers are builders, carpenters, and commercial contractors. There are 3 parts of the business, being the building trade centre, distribution, the frame and truss, and the formwork and commercial business, which gives us good diversity across the segments, some buying power and technical expertise. And as per the panels division, we are focusing on discrete parts of this large market where we can differentiate our offering. Go on to the next slide, slide 5. So this is a new slide we've put together to talk about the investment highlights or the investment thesis for the business. To give a bit of an overview, and I won't read through all of this, but we're a diversified, vertically integrated manufacturer and distributor in a very large addressable market. We focus our efforts on growth segments of the market where we can differentiate our offer. We have a strong financial profile, delivering positive returns both on profit and cash generation year on year, with upside and material cost synergies as volumes increase. And as I mentioned, we have a solid footprint across Australia and New Zealand. We've got 640 loyal staff with circa 10 years service tenure within our business, which delivers knowledge and expertise to service our customers. And we have a diversified and differentiated product mix. Our scale and supply chain diversity provides ability to pivot when the markets change, as we saw within our business during COVID. We're in a cyclical industry, as you know, with very positive medium to long-term fundamental opportunities. We now we'll go on to slide 6, and these are the results, sort of headlines, the performance headlines for the year. So in a tough market, the group revenue was 414.7 million, down 7.7% for the year. We're down 8.7% like for like, with the addition of taking out the addition of SLQ for the couple of months. Obviously impacted by that soft residential market, particularly impacting our frame and truss volumes. Our operating expenses were managed really well in a macro inflationary environment, up 4.1%, but again, without the SLQ addition, up 1.1% like for like. So we're very pleased with the way we've been able to manage those expenses tightly. EBITDA was impacted by volume decline and reduction in operational efficiency, again in those frame and truss sites, down 36% off record highs the previous year to $32.6 million. Our working capital continues to be managed very well, following year-on-year improvements in stock and debtors at 16.6% of revenue for the year. And onto cash conversion, again, what's most pleasing for the year in a volatile market is our strong cash result achieved through disciplined operations across the business, delivering a cash conversion of 98.2%. We can continue to pay fully franked dividends at 7.5 cents per share for the year, and at a 78.1% payout ratio. Now we go on to slide number 7. This here is our strategic priorities. I'll just that one up. There we go. This is our strategic priorities for the last couple of years, and again, I'll probably touch on these sort of by exception. But safety's been key and key to our strategy, and we've worked really hard to deliver improvements in site safety across the business. And we had the Geelong site achieve 1,000 days LTI free, and our Dacortex site at Penrose achieve 1,500 days LTI free. The focus this year on a challenging market has been to manage the metrics tightly, grow share in key market segments. We've continued to invest in the business to deliver scale benefits, operational efficiencies, and synergies. We've added so Scott Barclay, Gareth Watson, and Damien O'Loughlin joined our team. So this is part of our investment in people to drive the business, deliver strategy and growth and best practice for the business. And at the bottom there, one team. So that group rebrand, which I'll just show in a second, was launched in Q3, and this is about getting the team together and delivering one big river to the customers and for our teams. And again, I probably won't go through lots of detail here in terms of the new branding. Just to say that we launched in February. We've gone from 18 brands to the 3 you see there at the bottom. So obviously Big River and then Timberwood and Plytech. Plytech for New Zealand and Timberwood for the panels, cabinet maker business. And this is about getting those efficiencies and synergies across the group. Now every site has now is now and all our websites and all our marketing is now on the new brand. But we will be rolling out over the next 2 years across the sites here, the actual physical branding at the sites to manage the costs. We go onto slide number 9, the historical performance. Now this is the same slide we've sort of put up year on year. Now I won't go through each graph, but obviously a soft result on revenue and profitability are driven by a challenging market near the bottom of the cycle of historical very strong results in FY 22 and 23. As I mentioned, our fundamentals of managing cash, our cash position have been very strong. If we go onto this next slide and then reviewing the 5 years in terms of what we believe are the key achievements and the journey we're working through. We've delivered successfully on our acquisition strategy, acquiring 8 businesses across 13 sites over the last 5 years. They've all integrated well, delivering a national network's depth and capability and increased product and service offering. We've expanded our supply chain capability, growing relationships with international suppliers, consolidating purchasing, expanding our manufacturing footprint by 4 to 8 manufacturing sites, and we continue to expand our synergies and operational efficiencies, which will deliver improved profitability ratios for the business. And then on the right-hand side, I've noted some key metrics. So over the last 5 years, the EPS has grown 6.1% compound annual growth. The revenue 10.7 CAGR, and EBITDA before significant items 13.5% CAGR. And as I mentioned about the cash, we've managed the cash really well, and it's been a key focus. The average cash conversion over the last 5 years has been 99.6%, which is a fantastic result. Then onto the divisional performance. There's some soft numbers from the construction division with volumes and margins impacted by the decline in the residential housing and delays. Decline predominantly driven from the frame and truss business. Our commercial market project pipeline delivered positive growth in the later half of the year, and lightweight cladding is a growing segment and an area where we have been growing share year on year. Supply chain has been an issue the last few years, but those pressures have now all but eased, all back to normal, to previous, to before COVID levels. On to panels. Our panels division is later in the construction cycle and experienced stronger residential market pressures in the second half. The New Zealand business was soft, but it's good to hear the news of the decrease in interest rates, which may be a catalyst for a market turnaround. Specialised Laminates Queensland was added to the group. They've integrated well, added capability and synergistic opportunities, and the Grafton site was completed and is now delivering higher volumes of bespoke decorative panels and high-value formply. So now we'll get into some of the data on the P&L and balance sheet. I'll pass on to John O'Connor, our CFO.
Thank you, John. Good morning, everybody. As John mentioned previously, revenue was down 7.7% on prior periods, and that was driven by that lower residential activity across all of our markets. During FY24, we were still impacted by those labour shortages and site delays, but we definitely see an easing in those indicators towards the end of the year. Our gross profit result was 108 million, a 12.4% decline on the prior period. Our gross margin was down by 142 basis points. In previous years, we've benefited from the growth in the higher margin frame and truss business. And just this year, we've had the opposite effect of that, as that category has declined in line with that lower residential activity. But we've also seen just generally increased competitor activity, which means we've had to be more keen on our pricing. And we're just finding the market itself is just generally more contested this year. Our operating expenses have increased in the period, but on a like-for-like basis, they have been managed well at plus 1.3%. We've managed to absorb overall wage increases of 4 to 5% in the period, whilst continuing to invest in our people and systems. And we believe that leaves us well positioned to deliver now on future growth opportunities. So overall in the period, we had an EBITDA result of 32.6 million, which was 36% down on prior year. You'll see increases there in our depreciation and amortization line. Those increases were mainly driven by increases in right of use building assets. So where we've had market rent reviews in the period, we've seen double-digit increases. Now, again, John mentioned earlier, we have started to mitigate some of these by consolidating sites where we can, and we will continue to look at opportunities here as we go forward. Our overall finance costs were impacted by the full year of higher interest rates and the additional borrowing we took out on acquisitions during the year. The resulting NPAT was 8.1 million, a 62.8% decrease on the prior comparative period. Looking at the next chart, which is our waterfall chart. Look, to summarize this just shows you with our costs being well managed, a small contribution from SLQ. The EBITDA variance was primarily caused by that revenue reduction and the margin challenges we had during the year. Moving on to the balance sheet. Look, pleasingly to report, we've maintained a very strong balance sheet, and that just gives us confidence to continue with the strategy we have in place. We've maintained strong discipline focus on our debtor management. We have seen some stabilizing in that market, with not as many distressed customers in the second half, but we know from history this can deteriorate quite quickly. So it's an area we will remain quite focused on how we manage this. But pleasingly, we've been able to reduce our debtor days from 43 to 42. We've also maintained our inventory disciplines, and this sees us delivering a 2.3% reduction in like-for-like net working capital. That's excluding SLQ. The main increase there in inventories came through from SLQ. Our borrowings have increased by a net 2.6 million. The 5 million acquisition loan that we took down for SLQ, and then we reduced some of our working capital facilities in New Zealand. Moving to cash flow. Again, John highlighted this earlier. This was, I think, a particularly pleasing result for us. We came in at over 98% for the year. Given the challenging environment, we were very pleased with that. This was underpinned by maintaining those strong metrics in working capital that I mentioned earlier. There was a higher tax payment in the year, which was related to the FY23 year, which just cycles us out of those higher profit years. Our gross capex at 4 million was down slightly from the 4.7 in the previous year, and that was mainly due to lower spend on Grafton. The Grafton facility had a lot of investment in the previous years, and that was largely in commissioning phase this year. And then just closing out, confirming 11.6 million of dividends was paid this year. And then finally, our capital management page. Our net debt increased from 11.2 to 27.6. The big movements here being prior year income tax liabilities, contingent considerations paid, and that additional acquisition borrowing. The gearing ratio at 18.8% is still a good result and within our historic ranges, and it leaves us well positioned for any future acquisitions. Our total working capital as a percentage of revenue, as I said earlier, remains a focus as always, and it was pleasing to see this remaining broadly in line with the prior periods. And then finally on this page, confirming our final dividend of 2 cents, fully franked, has been determined and will be payable on the 4th of October. A good dividend payout ratio of 78% for the period. I'll now pass you back to John, who'll take you through the outlook.
Great, thanks, John. And look, this is the final slide, and then we'll get to questions. But just on the market and the outlook for the business. So the residential market has been soft and expected to remain that way for the next 12 months. There are strong medium-term prospects though for the sector, given the housing demand, low vacancy rates, and expected interest rate decreases in the next 12 months if they come through. And that commercial segment is looking promising for us, given solid project pipelines. Now, across the geographies, Queensland is our largest market, is looking positive, and Western Australia is strong, and South Australia is looking more positive. And we'll continue to look at M&A opportunities across the group and consolidating our purchasing power to mitigate increased competition and margin pressures, and then continue to invest in the business and processes, which will position the business well for when the market returns. So I'll pass it back on to you, Mark, and happy to take any questions.
Yeah, thanks, John. We've had a few coming in here, so we'll get straight into them. Question here for the layperson. It says, can you explain the operating leverage, in the frame and truss manufacturing part of your business? How much revenue was this in the FY24 versus the PCP, and what the incremental margins are? So maybe just talk about how the decreased volumes in that just particular segment really impacted the result.
Yeah. So look, we're not giving out the numbers in terms of specifically frame and truss, but what I can say, I won't be saying exactly what revenue that frame and truss is or the margin, but the margin for frame and truss is higher than the building trade centres, and we had a significant decrease in volumes, and thus in terms of operating leverage, the margins out of those sites, obviously the costs, our COGS, our labour within those manufacturing sites sit in the COGS line. So you obviously got a fixed asset. You double the volumes or thereabouts during COVID, where we were actually highly utilising those assets, and that's come off significantly. And so that's obviously impacted the revenue line, but had a larger impact in the margin line.
And then second one, then maybe for the other John, maybe somebody looking for a bit more of a breakout at the 75 million in operating expenses. What's kind of the main things made up in there, and then a comment on. I think you slightly touched on it, John, on wage increases and kind of non-wage, I guess, the inflationary environment more broadly going forward. Maybe just touch on that. I know John said the whole kind of supply chain has totally normalized now, so maybe just touch on that.
Sure. So I'm just looking for the breakdown here, Mark, if I have it in the accounts. Yeah, look, it's primarily made up of wages. That's the biggest percentage of our operating costs. And I think that was the point we were trying to make. We've managed to absorb that sort of 4 to 5% increase. That was a real increase in the year, along with the CPI. So we've worked hard at really trying to get efficiencies in that space. And look, in terms of the outlook, we still think there is opportunities there to try and be more efficient, and we will try and limit that increase below inflation in the next 12 months.
John, one for me. I know you've expanded the business a lot over the years. Is the footprint kind of done and dusted now, or is there still places you'd still like to be in? And a kind of a follow on to that in terms of acquisitions. I know we've talked about this when you presented at our in-person conference in Sydney. 12 months ago, a lot of vendors were maybe not willing to negotiate on prices. This last 12 months kind of reset expectations to kind of something more normalized.
Yeah. Thanks for the question. Look, the acquisition strategy is still key to our plans, and there are still definitely some geographical areas for us to look at. And look, I mentioned there the panels business being in the East Coast and New Zealand, which basically means that we don't have anything on the West Coast or South Australia within the panels business, and then we definitely like to have some businesses there. We've looked there, and then in the building trade centres and frame and truss, there's definitely gaps in our offer. I suppose where the strategy's changed maybe a little bit or morphed a little bit is that we're not just looking for dots on the map, we're really looking for businesses that will deliver the volumes and the scale benefits, but also strategically, importantly, some capability that maybe we don't have. And if you look at the SLQ business as a good example, we bought a business here geographically is important in southeast Queensland, but it delivered a bunch of capability around manufacturing and around different market segments and some logistical benefits across our sites, right? So strategically really fitted in well, as opposed to just being another dot on the map to grab some market share, right? So I think the answer is yes, we'll continue to do those. And then the second part to your question is around the vendors. Yes, people are definitely keener. We are seeing quite a few distressed vendors or distressed businesses with vendors who really are very keen to sell. But as I just mentioned there, we're really looking at businesses. We're not looking at buying businesses to fix. We're looking to buy businesses that will add to our business. So we generally won't buy businesses in distress. But the multiples have come off the last 18 months.
Yeah. Another question in from the audience. In your experience, given the positive factors, immigration, housing shortages, we know all about those, is it interest rates cuts the factor you expect to have the biggest impact on the resi part of the business? So I guess you've got, we know that two other factors are driving long-term demand, but is it really the interest rate cuts that are, the biggest way how would you treat them?
Yeah, look, absolutely right. Look, it's about consumer confidence. I mentioned it in the announcement. Consumer confidence and interest rates mean that people feel like they can go and spend money on either upgrading their home or buying a new one. And while the consumer confidence is low, that's an issue. Historically, the interest rates aren't that high, but there's uncertainty out there, right? So I think a cut in the interest rates will then mean, the consumers are then and also developers are then a little bit more positive around moving forward. But there's also the labour component that's been an issue. We had very large approvals over in 2020, 21, and they didn't really come through until 22 and 23 and the start of 24, right? So, and that was labour shortages, right? So I think being able to deliver them at the moment, South Australia is pretty strong. but what's holding up South Australia is whether they can deliver the homes or not. So I think it'll be both of those things. And then there's all the government issues around land and land availability. But at the moment, with the market being soft, no one's talking about that.
Yeah, the perennial land debate.
Yes.
In terms of if we look out, take from where the business was listed and we look out another 5 years, should we expect panels and commercial to kind of be 50-50? Is that kind of the long-term strategy where you've got kind of a resi focused business and a bit more of a commercial focused business? And, because there are two different stages of the cycles, they somewhat balance each other, or is it, resi will just always naturally be bigger?
Look, we haven't really thought about it that way. Look, there's bigger opportunity for the residential or the building trade centres to grow substantially, because obviously that market's quite big, right? So, but what we've done over the last few years, firstly, we've looked at businesses, both in the commercial space in formwork and commercial sort of business, the frame and truss, the building trade centres, and the panels. And as I've said, we've looked at businesses that fit our criteria in terms of scale and profitability, and that deliver on the strategy. We've probably had better luck finding the right businesses in the panel space, and they've also then given us a better mix, right? So these businesses have given us bespoke products that are differentiated in the marketplace, which help, and then good margins as well. So we'll be looking at that space. I think in the short term, obviously SLQ will have another 12 months, so the panels business will be a larger percentage in the next 12 months. But if we find the right business in the building trade centres, and it's a $50 million turnover business, then we'd look at it, right? So we're not really looking at it in terms of trying to make them 50-50, but they have to meet our criteria.
Yeah. And then just a question on CapEx, I think maybe for the other John. Grafton is kind of now, as you say, kind of done and dusted, but you've got the rebrand, the ERP rollout is still, happening away in the background. But in terms of that 4 million CapEx that was spent this year, should we expect the same again next year, with these other kind of smaller projects which are kind of happening in the background to be replacing, the big project that happened with Grafton?
Yeah, no, you're probably spot on there, Mark. It's we see sort of the level of investment needed around that sort of 4 to 5 million per annum just across all the other branches. Yes, the focus has been on getting Grafton resolved in the last couple of years. So we would like to sort of look at the whole branch network and see where we can sort of make some good sort of CapEx investments there. Unfortunately, ERP is expense now, so I can't put that in CapEx anymore. So there won't be anything on that. But yeah, look, it's probably a good number, I think, to as a base going forward. That should enable us to improve what we have and then look at opportunities to invest that'll bring more efficiencies to the business.
Okay, perfect. Gentlemen, we've gone slightly over time, and I know you probably have a few more of these on today, given the results were just out yesterday, so I won't take up any more of your time. John Lorente, CEO, thank you very much, and delighted to have us for the first time another Irishman on here, John O'Connor, CFO of Big River. Thank you very much, and for everyone who attended, I hope it's been a good week. It's been a long week. It's been a lot of results, and everybody enjoy the rest of your Friday and have a good weekend. Thank you.